The United States and India are locked in one of the most serious trade disputes of the decade. New tariffs of up to 50% have been slapped on Indian goods entering the U.S., and India has retaliated with its own set of tariffs on American exports. On the surface, this might look like another economic scuffle. But in reality, this is a geopolitical showdown with consequences that stretch far beyond dollars and cents. It's about power, partnerships, and the balance of global trade. So, what exactly happened, why now, and who's paying the price? Let's break it down. The dispute began when Washington accused India of unfair trade practices. U.S. officials argued that India was keeping tariffs low for its own industries while maintaining barriers against American goods. In response, the U.S. rolled out sweeping tariffs targeting Indian textiles, machinery, and pharmaceuticals. India, unwilling to back down, hit back with tariffs on U.S. agricultural exports, technology imports, and certain defense equipment. Within weeks, billions of dollars in trade flows were disrupted. The first victims were in retail. American clothing brands and retailers that rely heavily on Indian textiles are now dealing with much higher costs. India is one of the world's largest textile exporters, and tariffs of up to 50% make imports far more expensive. Retailers have two choices: swallow the costs and lose profits, or pass them along to consumers. Either way, the outcome is painful. Shoppers in the U.S. may soon notice higher price tags on everything from fast fashion to luxury linens. Technology is another sector feeling the squeeze. Many U.S. electronics companies source parts or assembly work from Indian factories. Tariffs are pushing those costs higher, forcing firms to scramble for alternatives. Some are turning to suppliers in Vietnam or Mexico, but supply chains take time to reconfigure. Meanwhile, India's IT services giants, companies like Infosys, Wipro, and Tata Consultancy, are watching nervously. While they haven't been directly targeted, there's growing fear that political tensions could spill over into outsourcing restrictions or new rules on cross-border data. Agriculture may be where the pain feels sharpest. American farmers, especially soybean, corn, and grain producers, have long depended on India as a key export market. With new tariffs in place, their products are less competitive. Indian buyers are already shifting to Brazil, Argentina, and Australia. For farmers in the Midwest, this is déjà vu. They lived through a similar nightmare during the U.S.-China trade war, when Chinese tariffs shut them out of their biggest market. Now, years of market building are being undone overnight. On the other side, Indian exporters are struggling too. The U.S. is one of India's largest trading partners, and losing access to that market is a major blow. Small and mid-sized firms, especially in textiles and manufacturing, are being hit hardest. Margins are shrinking, layoffs are beginning, and some factories are closing. For larger companies, the pain may be manageable, but for smaller exporters, these tariffs could be a death sentence. Beyond industries, the bigger picture is geopolitical. For years, the U.S. and India have drawn closer as strategic allies. Washington has leaned on India to counterbalance China's growing influence in Asia. Defense partnerships, tech collaborations, and shared democratic values have strengthened the relationship. A trade war puts all of that under strain. If tensions escalate, it risks weakening one of the most important alliances of the century. And ironically, it could push India closer to Beijing, the exact opposite of what Washington wants. Why is this happening now? Analysts point to two main drivers. The first is domestic politics. In the U.S., taking a tough stance on trade plays well with certain voter groups, especially in manufacturing states. In India, pushing back against American pressure fuels nationalism and political pride. Both governments want to look strong at home. The second driver is economic slowdown. With growth cooling and competition intensifying, both nations are trying to shield domestic industries. Tariffs become weapons in that battle. The ripple effects are global. For businesses, the lesson is clear. Trade politics is now a core business risk. Companies can't assume stable markets anymore. They need to prepare for volatility, diversify supply chains, and build resilience. That means U.S. firms that depended heavily on Indian suppliers are accelerating moves into Mexico, Vietnam, and Southeast Asia. Indian exporters are chasing new customers in Europe, Africa, and the Middle East. But these shifts are costly, and in the short term, everyone loses. And let's not forget consumers. Tariffs don't stop at the factory. They ripple all the way down to shoppers. Americans will likely pay more for clothing, household goods, and some tech devices. Indian consumers will see higher costs on imported foods, agricultural products, and technology. Inflation pressures are already weighing on both economies, and tariffs make them worse. The long-term risk is escalation. Trade wars often start narrow and then widen. If the fight spreads into services, investment, or data, the fallout could be far more damaging. Imagine U.S. restrictions on outsourcing, or India limiting American tech companies' access to its massive consumer base. These are not far-fetched scenarios, and if they happen, they'll reshape the global economy in ways that go beyond tariffs. So who benefits? In the short term, very few. But some competitors in third countries, like soybean farmers in Brazil, textile makers in Bangladesh, or electronics suppliers in Vietnam, may seize market share that U.S. and Indian firms are losing. Global trade is competitive, and every conflict creates openings for others. Here's the bottom line. The U.S.-India trade war is more than just tariffs and numbers. It's a stress test of one of the most important economic partnerships in the world. If Washington and New Delhi can resolve this quickly, the damage may be limited, but if not, the consequences will ripple across industries, weaken alliances, and shift global supply chains. For businesses, the lesson is simple. Geopolitics is no longer background noise. It's front and center in shaping costs, risks, and opportunities. And for the U.S. and India, the stakes couldn't be higher.